All right, everyone, this is Matt Lengel again, coming to you with the next video in our series, part 2 of private equity, which is going to be aiming at venture capital. So in our last video, we talked about the buyout fund side of private equity. So now we're going to focus on what venture capital is within that asset class of private equity within the private markets. So to start, when it comes to venture capital, there's multiple stages of the venture capital life cycle, from early stage, late stage, venture growth. And I think it's worth mentioning that venture capital is fundamentally looking to invest in unprofitable, early stage, non-mature businesses with the hope of 10xing, 5xing your return. And this makes it incredibly from a risk perspective, sort of very big boom, very big bust. So as you invest in companies that are unprofitable at the moment, the potential for these huge returns is very enticing. But what comes with that is expected loss ratios, of over 50%. And so as we look in terms of what these different types of stage of venture capital will do, if we kind of put it all into one big basket, you'll notice that while venture capital has had some really strong returns over the last 10 years or so, back in the early 2000s, we really weren't seeing much at all out of the venture capital stage. Now, venture capital has become somewhat of synonymous with the idea of Silicon Valley and tech investing, right? So once again, think back to the idea of investing in early stage unprofitable companies in their infancy like Uber or Facebook or Google. You'll start to understand the potential return that you can have if you owned a piece of the equity within those companies before they went public. And as a reminder, when it comes to venture capital, there's incredibly long hold times in these. So and hold times have continued to extend upwards of 10, 11 years on average, because the main way that you're going to really reap the benefit of your return is through IPO, so initial public offerings. So that privately held unprofitable company, as it matures and becomes larger and larger and its revenue numbers become bigger and bigger, as it IPOs, your equity portion in that company is now going to create a huge windfall for yourself within that investment, which can be incredibly enticing. Now, sort of like buyouts, though, I think it's worth mentioning in terms of top fund managers have continued to have strong returns, but we've really seen a decline in the bottom quartile of VC fund managers out there. Now, when I say VC fund managers, obviously there's a couple different ways to invest in venture capital. It can be a family office, or you can be an ultra high net worth individual, and you can peel off $500,000 and you could put it into a business that's come to you with a pitch as they try to grow. When it comes to VC fund managers, they're doing the due diligence, they have access to deal flow, and you're thinking of big names such as Andreessen Horowitz, Sequoia Capital, Founders Fund. Some of these names that are stalwarts in the industry and have a long track record of helping founders capitalize on their businesses and create excess returns through initial public offerings and sales to capture the equity investment that they created and invested into these small, unprofitable, unmature companies in their infancy, and help them grow throughout and have the means of helping them advance to the point of an initial public offering. So that's going to do it for the private equity side. As a reminder, the asset class of private equity within the private investment universe is made up of buyout funds and venture capital. We've now talked about both. Going forward, we're going to speak on infrastructure and where that fits within the asset class of the private investment universe and where it might fit in terms of a portion of it within your overall portfolio. As always, please feel free to reach out with any questions you may have. We are always happy to discuss how this may fit into your individual portfolio. Thank you.